Apple reports earnings the 30th of July. The options market is pricing in a 5.4% move, but Apple has averaged 0.5% on earnings day over the last 2 years. That is a 10-to-1 gap. Let me show you what is happening. Apple is up 16% this year, trading around $315. The stock re-rated hard after WWDC when they announced the Siri overhaul and on-device AI for iOS 27. iPhone revenue last quarter was $57 billion, up 22% year over year. Management guided Q3 revenue between $108 and $110 billion. Here is the chart that matters. The options market expects a 5.38% move on earnings, roughly $16.60 per second hair. But over the last 8 quarters, Apple's average actual move on earnings day was negative 0.53%. The options are pricing a move that is 10 times larger than what actually happens. That is extreme, even by earnings overpricing standards. Implied volatility rank is at 67, meaning IV is higher than 67% of the past year. The 30-day historical vol is around 39%, but the ATM options are pricing well above that heading into the print. This is the classic pre-earnings IV build-up, and the wider the gap between implied and realized, the more premium sellers collect when IV crushes after the announcement. The play is an iron-condor around the earnings print. You sell the expected range, the market's 5.4%, and bet Apple stays within its historical range of about 1 to 2%. The entry deadline is the 29th of July, the day before earnings. The earnings call is after the close on the 30th of July, so you hold overnight and close the next morning after IV crushes. The risk is real. Apple is the largest company on earth. If they announce something that genuinely surprises, a massive AI deal, a China ban, a revenue miss, the stock can gap 8 or 10%. It has happened before. The 10x overpricing means the odds favor the seller, but the tail risk is what you're underwriting. Size accordingly. Apple earnings, the 30th of July. 10-to-1 overpricing on the expected move. The math favors the premium seller, but respect the tail. See you next week.